Welcome to another episode of the Anatomy of the Trade. Today we're going to discuss a hedge trade that Franz had in Qs, and he's using SQQQ. So that is the leveraged inverse QQQ. So with that, let's have a look. Franz, please explain to us the analysis first.
Okay, well, first of all, a little background. My portfolio has a number of positions in NASDAQ stocks, and long term, we seem like we're in a continuing bullish market condition, but in the kind of intermediate term here, we're going through a correction. So my thought is, what is the extent of this correction going to be? Where is the weakest part of the market? And should I consider, if this becomes more of an extended up and down sort of trading range environment, should I consider hedging my positions maybe at the top of the trading range, getting out of the hedges at the bottom, so on and so forth. So that's my rationale. And the reason for choosing the Qs is because, and you go over this every week in WMD, the strongest place in the market recently has been sort of the recovery stocks, the Dow index, the S&P coming back, and the weaker areas have been more recently, especially the over-the-counter, the Nasdaq 100. So that's where I decided the place to go against the market was the most logical.
Yeah.
I'm explaining it well.
So a couple of things. We're talking about the hedge trade, guys. So this is a completely different than your regular directional trade. So with the directional trade, we want, what do we want? We want to be in the correct bias, obviously. We want to be with the correct timing, and we just ride in a trend. Here, with the hedge, you could have two types of trades. You could have the trade within the trading range, right? So those are going to be oscillating trade. And usually this is going to be our reaccumulation type of hedge, where we're trying to find the spots at the top of the trading range, at the resistance, and we want to get out around the support. And then you could also have trending hedge trades, which would identify a much deeper distributional condition. So sometimes those trading range oscillating trades could be converted into a trading hedge. So for instance, COVID was a really good example of that. You might be opening the hedge, which then transitions into more of the trending directional type of trade. So that's the whole intent here with this particular trading. And then in terms of the analysis, so right here, when we were, it kind of was interesting. I'm going to kind of relate this to myself. So this rally right here, I personally was extremely bullish. I don't know, if somebody, follows our WMD or any other output that we have, like literally right here, I was super bullish. And then a day like this comes. So you start doubting yourself, your analysis as to, like what's going on here. We're not overcoming, let's say, this resistance. So hedges are the trades, especially in the trending environment, that are basically going to eat up some of your profits, some of your profitability. Think of them as the insurance, right? So when you buy an insurance, let's say you buy a car insurance, and you go years and years without any accidents, without any problems, and you kind of, in your mind, might be thinking like, well, I'm wasting the money. Well, in reality, you're not, because the accident could happen, and then it's going to be a lot of money that you're going to spend on this accident. So that's what hedge in the trending environment is. And those are extremely difficult. Again, if we would go to, let's say, previous reaccumulation, I mean, Franz, what was your opinion? Where would we have a really good hedge? I mean, we can't really, like, there are some conditional hedges that we could put on the climactic run, but those are really difficult to put on. A bar like this develops right away, and then you're thinking, okay, well, what's the potential here? Well, maybe we're going to go to this area right here. So I'm not really having a lot of ground to cover to the downside. So it kind of could be problematic. I think that maybe a hedge right here was also a possibility. Maybe a hedge here is the continuation. But in all of the cases, you kind of could see the limited amount of distance that could be traveled just because we are in the trading range, just because we are in the reaccumulation with the idea that the uptrend is going to resume. So first of all, it is not an investment. It is a trade. You have to be on it. And then, you have to recognize the overall conditions of the market really well. And also have the mentality of like, it's an insurance, so I might be paying the insurance premium and not collecting anything. So usually it's a drag on the portfolio, but it's a necessary drag sometimes. So Franz,
And by the
specific.
way, I think that summarizes the whole issue perfectly. And one of my conclusions, which we'll get to in a little bit, is that hedging within a trading range is pretty difficult.
Yes, yeah, yeah. Uh, just because of the limitation of the trading range itself, and then
Mhm.
also limitations of specific signals, right? So, for instance, if we're talking about this signal right here, this acts as a confirmation. And therefore, it's also a point of entry, but it's the latest point of entry. I mean, like obviously, this is the first point of entry, then this is the second, and this would be the third, right?
Mhm.
So we are coming in a little bit late. So with the trading ranges, hedges, and those, obviously, like conditional points of entry are probably better, but yet, very hard to spot and act on. Plus, we were discussing quite a few scenarios here throughout, this trading range. So one of the scenarios was, and please go and check this out, 2018, where we had kind of the same structure, this formation, this uptrend, and this change of behavior, and then this area right here where there could have been a possibility of something like this and continuation to the downside. Now, in this case, this hedge would work amazingly well. And I think this was maybe like the idea at that time. Plus,
Yeah,
I
that's
want
the
to,
insurance aspect.
yeah, and also want to kind of point your attention, guys, that the relative strength relative to the S&P is showing weakness. So the asset as a shorting asset was picked up absolutely correctly. So let's look at the trade itself. How did it look on the SQQQ? So Franz, walk us through this.
Okay. And you have to look at this kind of like you're looking at a mirror. It's reversed. So as this is going down, the QQQs are going up. So as this is going down, we're getting to the top of the trading range, that trading range that Roman showed us in the previous slide, and we start to go back down again. So the initial entry was on the 17th at $13.56, and where am I wrong? Well, I'm wrong if this reverses and continues to go higher. So that's where my stop loss is placed, and I got stopped out because there was a sharp reaction, sharp one-day reaction, and the so I'm out of the hedge. Well, then the market starts to go back down again, And again, you're looking at this in reverse, so it's, you got to think about it as a mirror. There's a reversal back down as we get back to the top of the trading range for the Qs, that little trading range that we're in. So again, I gave it another shot. There was a bit of a confirmation. So I got in initially on the 23rd. There was a bit of a confirmation bar, and this is just a 2-hour chart on the 24th. And it started to work. And again, I had my stop if I'm wrong, if instead of this going down, instead of the Qs going down, they can, this is this is the beginning of an up move, which it turned out to be. So on the looks like the 1st of April, my stop got hit, and since then the Qs have been performing rather nicely. So the hedge is no longer necessary and is no longer even viable.
Mm-hmm.
So
Mm-hmm.
that's the explanation.
Yeah, and again, I just want to reiterate that, when we think about the hedge, we're thinking about the insurance. What if the market would go down, right? So we would definitely touch this high right here or the low on Nasdaq. So this type of move, and who knows? Maybe we're going to continue even to the next target. So that's the whole idea behind the hedge. And I think that execution-wise, I mean, we probably could optimize a little bit here, like stopping out. So it seems to me that maybe the stop loss was slightly too close.
Yeah, I think so.
Yeah, slightly too close. Maybe like put it somewhere like go always to the left. What is happening to the left? Where is the buying has happened to the left? And I think that it's this bar right here that was breaking out locally here. So I would be thinking that the stop loss should be, a little bit at this level where the buying has started. So that way we would be at least, 2 support levels away in the area where the buying has happened before. Our expectation if the price goes there, that the buying will happen again, which it did. So just a small adjustment on the stop loss itself. But then everything else, I think, is fine. It is what it is. We had a hedge, and the market went into the continuation of the overall trend, and that's the signal to close off the hedge, and we did. So with that, I would say that it's a good trade to as an insurance trade to what could have possibly have come our way. Okay, so Franz,
A couple of additional observations
yeah,
too.
okay,
Because it's a triple leveraged instrument, there's not as much. In other words, the amount of shares, that the size of it doesn't have to be as great to to correctly cover open positions. But what I found is that my open positions were a lot more volatile to the downside than this was volatile to the upside. So it was a learning experience as well as just practicing a trade with real money and practicing hedging.
yeah.
I learned a lot.
Okay, well let's go through the post analysis. So bias.
The bias, I'd say, for the bias is probably no, because the hedge wasn't necessary.
Well, I
Um,
mean, it was necessary because we were having volatility within the trading range, but um, it didn't work out. I would just kind of phrase it like that. Timing.
I think the timing was okay.
Yeah, timing was okay because I mean, if we are continuing to the downside, then this would be a really good timing. We are doing this in the area of the support here, so yes, okay, character.
No, I don't think so. I should have been more bullish like you were.
Well, I mean, remember how I was bullish? I was really bullish here as the price was trying to get out, and then I had my doubts as the market turned around so quickly like that Thursday after WMD. So, okay. Well, point of entry, I would say probably yes, because we're opening at the support. Stop losses. So yeah, that
Probably
first stop loss
50-50.
could
Probably
be
50.
improved.
You know, I put the stop loss on. I just didn't have the first one with quite
Okay.
enough breathing
So
space.
add-ons
I
you
I
had in the
did have an
second.
add-on.
Yeah.
Yeah.
Okay. And then the exit. The exit was okay. So 4.5 out of what, 7, right?
Mm-hmm.
Okay, so I believe this is 64%. Okay, so what are the main lessons, observations here, Franz, for you?
It's very difficult to do this in a trading range, and the narrower the trading range, the more difficult it is.
Okay,
But as you say, it's insurance, so you have to put it on the scales. How much, how much am I willing to give up if the market
yeah,
is in a trading range and my entries aren't right versus how much it costs me to do it?
yeah. And by the way, guys, we didn't mention this, but when you hedge, there are different ways of hedging. I mean, like it's not
Mm-hmm.
only that you could buy the inverse ETF, right? So you could trim your positions. That's probably one of the ways to do this. Then hedge with the, let's say, inverse ETF. You could also hedge with other tools like you could have like options positions. You could have futures positions against the market.
Mm-hmm.
You could um, there was
You could be
one.
selling individual
Yeah,
shares short.
yeah, sell and short. And the way how you sell short is that you kind of do this pair trade, right? So, for instance, uh, you have the existing position, and then you pick a correlated asset or correlated stock, right? So, for instance, if you have NVIDIA in your portfolio, you need to find a semiconducting stock, which is, let's say, stronger in this case, right? If we want to, actually weaker, if we're
Weaker.
holding NVIDIA, yeah, and then short that. So effectively, you're shorting you're long one semiconducting stock, and then you're shorting another one. So you're almost fixating, your equity line, and because the second stock is going to be weaker, it has more potentiality to go lower, and that's actually quite effective. But you got to be a trader to do this type of stuff. You cannot
Mm-hmm.
just be an investor. Okay. Um,
And you're limited if you've got a retirement account because you can't sell short in a retirement
yeah.
account. So,
So.
so.
Mhm. Okay. So I would say that my comment also would be look for conditional trades
Mm-hmm.
at the top and at the bottom of
Mm-hmm.
the trading ranges. So those are going to be a little bit more effective within the trading range itself. Those are extremely difficult because you have to foresee what's going to happen based on the conditions that are forming still, let's say, in the bullish type of way. So, somewhere here, somewhere, let's say here. And this was actually a good place to initiate, those hedges with anticipation that there might be a continuation. Um, but obviously, anything like right here would be the best. Anything here, in the opposite direction would be the best. Okay, well, Franz, your final thoughts?
Well, it was a good exercise because it's it's helping me to continue to build on my analytical skills, to build on my trade management skills, um, and I just think from both of those points of view, both of those perspectives, it was worthwhile. It cost me a little bit of money, but it was a worthwhile learning experience.
Yes. Okay. Well, great, Franz. Thank you for sharing this trade. Good discussion on hedges. So with that, guys, thank you so much for watching this episode, and we'll talk. We'll see you in the next episode. Thank you so much.
Thanks, Ramon.